everyone, welcome to the channel. So today I want to talk a bit about why I moved from traditional fund research to sustainable fund research. So some of you may know that I previously researched hedge fund strategies, which is great, really interesting. I love the whole derivative side of it, using all my financial maths to calculate option price payoffs and things, which was just so interesting. And I guess leading into the COVID crisis of 2020, some of those option strategies that we're involved in, also some tail hedging strategies, actually perform really well. But it's quite disconnected from the real world, to be honest. I found myself kind of elated by the fact that we managed to protect our clients' capital and perform well. But then I found myself kind of sat at home in the middle of a pandemic. People were dying everywhere, and it was just an awful kind of crisis that arguably could have been avoided if we prepared better for the potential of a pandemic outbreak. About the same sort of time, I was doing the ESG CFA exam, and that was just very eye-opening in terms of some of the social and environmental issues that we're currently faced with. And I think that just kind of brought together with the pandemic, just created a laser focus on some of the social problems and environmental problems that we have in this world. I guess another reason why I kind of changed at this time was because, if my previous role was protecting the portfolio against these kind of big market sell-offs, there arguably wasn't going to be one for a long time, or nothing kind of to the extent that we've just seen. So I started to think about what I might like to do next. And, as I said, the COVID crisis put heightened focus on all these social and environmental risks that prevailed in the market, and I just really wanted to understand how we could do something better. Part of my role as a hedge fund researcher was looking at tail hedging strategies, and I went back and read all about essentially market crises in the past, and they do tend to happen fairly frequently. You had the pandemic in 2020, and then 12 years prior to that you had the global financial crisis. 10 years prior to that, you kind of had the dot-com boom, and 10 years prior to that, there was another crisis, and so on and so on. So it's kind of interesting to see and kind of understand markets have this kind of, boom and bust cyclical phase about them. And my role as a hedge fund researcher was very much about, I guess, taking advantage of those booms and busts and that cyclicality, and particularly the bust phase, protecting our clients, creating a much more smoother path for our clients. Because we all know that volatility actually has a cost to it. If your uncertainty has a cost to it. So the smoother we can get our pathway, the better the Sharpe ratio essentially of our portfolio's performance, the happier our clients are, and the better they are able to meet their objectives. So, long story short, hedge funds, great, can make lots of money in market downturns. But it started, I guess the damage caused by market downturns always just really got to me. So you could just say that cyclicality is, inevitable, and the best thing to do is just to, try and insulate our portfolios against it, and invest in tail hedging strategies, invest in hedge fund strategies to help make sure that our clients' returns are just not as volatile. But as I said before, at this sort of time I was looking into sustainable investment research, and I just really kind of hit me as a potential solution. So what if, instead of just accepting that markets have these boom and busts and it's just the nature of capitalism, why not try and change the types of strategies we were doing to make them more kind of resilient and robust? And why not try and change the financial system to ensure that we have a much smoother path, that risks are more accurately priced, and that there is just generally lower volatility and fewer surprises in the market. So that kind of led me to sustainable investment and sustainable fund research. So I think that gets to the bottom of it. So if we understand that there are kind of systemic risks in the market, some of them we actually do know about, and I would call these kind of, what do we call them, like known unknowns, and then there's unknown unknowns. So the known unknowns, the biggest one out there is probably climate change, right? We know it's happening, scientists have told us it's happening, yet we continually don't focus on it in financial markets. And that kind of led me to try and understand how we could incorporate it into financial markets. And it completely led me to focus on how can we embed climate change and net zero investing into our investment decisions to ensure that we are taking into account these systemic risks. Starting with climate change, but also happens for social as well. So like, can we get all this extra information into our decision making process, because this information, these known unknowns, such as a pandemic was a known unknown, right? Like, so we knew that the pandemic was possible, but we just didn't know when or how it would strike. Just like climate, I guess, we don't know when or how it might strike. So I think sustainable investing really does provide an alternative future for investment, to better help us understand and take into account additional systemic risks, and thereby help price it and better insulate our strategies against those risks. And kind of at the heart of, I would say, sustainable investment is this idea that neoclassical economics is kind of missing the point a bit. When you talk about the role of the firm is just profit maximization, then you kind of realise that actually it's missing a few bits, and this has created some emergent behaviour. So when you start looking into sustainable investment, you realise that actually at the crux of it is this idea that neoclassical economics is kind of flawed. So this is the kind of philosophy put out there by Kate Raworth in her book Donut Economics. I think you can kind of say the same for investment theory. So a lot of investment theory, and the investment theory that I learned throughout my financial education, through being an actuary and through the books I read around the subject, they kind of are good, but they are just models, and they, like any model, they kind of have blind spots. And when a model has blind spots, it's important to think about other models that can help alleviate those blind spots. I mean, it kind of goes back to my time as a hedge fund researcher as well, where I'd studied stochastic calculus and financial maths and derivative pricing all through university and all through school. And then when I tried to actually apply it, I realised that it tends not to be an amazing model. Like, it works some of the time, but the markets tend not to move in perfect Brownian motion. There tends to be surprises and there tends to be jumps. So you can't rely on that as a model. So it got me thinking about what's the alternative model here. And so, like in Kate Raworth's book saying neoclassical economics is good but flawed, I think modern investment theory is kind of good but flawed. There's extra information that investors need to take into account, because when they invest, they aren't just looking to maximise profit for shareholders. They have to recognise that their investments are part of a system, a financial system, and that the firm's actions do kind of have implications on various stakeholders, be that the firm's clients, the planet, society. You can see this on a much smaller scale when you look at, I think of shops down the road that have just recently opened, and how they can transform a kind of community. Like, the quality of food I'm eating is slightly better just because we've got a shop that sells something slightly different, whereas before it was just a petrol station. So, in essence, it's very clear to me that modern investment theory is kind of flawed. And this new investment theory of layering on additional information, additional things to think about when you're making investment decisions, actually is a really good way of managing money and helping to reduce this volatility. If you reduce those blind spots, then they're less likely to come out of nowhere and bite you. And if the whole market did that, then there'll be a whole lot less volatility. It does remind me of one of the books I have. I think I bought it at the time. Here you go. Yeah, it was the Body Economic. It just gives you the impact on society of the major market downturns. So again, sustainable investing, I believe, is the solution here. So yeah, sorry, got interrupted there. But the more people that take into account the extra information that sustainability information provides, or ESG information provides, I think the better and more robust and resilient the financial system will be. And that's obviously a good thing. More stable financial returns, more accurate market pricing, longer term focus, better for humanity, better for returns, better for everything. Then I think once you've eliminated the kind of known unknowns and more accurately priced them, it's all about the unknown unknowns, and then that gets more interesting but a lot rarer. So yeah, in conclusion, Long ramble, but the reasons why I moved from traditional fund research into sustainable fund research, perhaps I could have carried on trying to find managers and strategies that would be able to profit from the fluctuations in financial markets, the short-term nature, the inevitable booms and busts, or I could focus on strategies that were a bit more resilient and robust to that, while also helping improve the financial system. I guess, yeah, when it comes down to it, it's kind of like, do you medicate the symptoms or address the cause? And that's one of my favorite discussion points and philosophies. Is it better to just recognize the symptom of market volatility, booms and busts, crashes will always just exist, and then we just find investment strategies that can profit in those situations? Or do we try and address the kind of cause of this, which I believe a lot of it is to do with not including all the relevant information to investment decisions, in addition to some behavioural issues which we might touch on another time. So that's the kind of key reason why I moved from traditional investment to sustainable investment. I decided that while kind of fun and interesting to try and profit and make money from the booms and busts of the market cycle, why not try and focus on addressing the causes of that and improving the system from within? And yeah, that's how I've ended up here. I think sustainable investment, yeah, I mean, why? I think it's because I realised that life is so much more multi-dimensional than just money and making returns. When the pandemic hit and the financial market started to crash and our tail hedging strategies started to perform really well, yeah, it felt good, but I was at home. My wife was working in hospital and was having to go to work. People were dying. And so while you can profit and protect portfolios, market downturns and market crashes, the damage they have on real life, the day-to-day, I guess not just you, the damage on society and everything else where we live, everything, we lost our freedom, all this stuff, just because we failed to kind of plan, prepare. We talk about this kind of medieval system where you wait for something to happen and then you kind of then deal with it afterwards, this kind of reactionary rather than proactive time way of dealing with things. It doesn't work because by the time you've reacted, often it's too late. You need to put things in place before, and that's what we're doing with climate change and net zero. We're proactively starting to take this information into account because it's happening, and I think it's obvious that it's going to create some market volatility, and if it doesn't create market volatility, there's still going to be some serious kind of social and environmental implications, and the world's going to change a lot. So overall, moving to sustainable research, so we take into account more information into our investment decisions. We have a long-term focus that creates more robust and resilient investment strategies, while also promoting, the improvement of the financial system, i.e. making the financial system more sustainable, less prone to booms and busts, and overall this will create lower risk strategies, longer term higher returning strategies, and a better world for everyone. So thanks for watching. I hope you found this useful. Bit of a different video, a bit of a ramble, but if you have any questions or comments, please leave them in the comments section down below. And as always, don't forget to like and subscribe to the channel for more sustainable investment content. Thanks.